Hey folks, Brett Pattison here with IronGate Global Advisors, coming at you today to talk about a very important subject. In a world of 0% interest rates, I think this is a very timely discussion to have, so I'm excited to be teaching and talking about the income approach, which is the IGGA approach to finding income through options. Please note before we get started that we will be talking about options, and options are not for everybody. There's certain risks that you need to understand, which we will address today. And as you want to further understand those risks, certainly we can do that one-on-one. But here is what we are going to discuss. We will discuss the current state of income in today's markets. When I mentioned 0% interest rates, I'm going to talk a little bit more about that. We'll also talk about how options should be used in a portfolio, and then we'll go in and we'll demonstrate an income type strategy using options that we apply to clients in clients' portfolios when it makes sense. So let's talk about the current state of income. And in this little chart here that I just pulled from the Wall Street Journal, you can see the Treasury yields. In fact, let me highlight those. The Treasury yields of the 2, 10, 30-year Treasuries. And a couple things that I want to mention there on that particular, within that little square or rectangle. And that is the 2 years right around 0.65 as we talk, the 10-year right around 2.1, and the 30-year is between 2.7 and 2.75. So that's where we stand as far as yields go. The safest yields that you can find in today's market are yielding you a maximum of 2 right around 2.75, call it, on the 30-year. Okay. Now let's highlight a few others, and that is you can see there the money market annual yield. They're kind of on the bottom part of that highlighted rectangle. The money market annual yield is 0.42. So that's your money sitting in your brokerage account or sitting in a bank account, yielding you 0.42. A 5-year CD annual yield will get you 1.5%. And I know all of you are looking at that just thinking how much money you're making. I say that jokingly, of course, on these yields. And let's factor in another thing that's important that we understand. Inflation, you see some numbers around 0.8, some numbers at 1.8. Let's just say, for the sake of argument, that we're about 1% in inflation. Okay, so if you take that 1% and you subtract it by, say, the money market, then you're looking at negative real returns. Your money's actually sitting there losing purchasing power in a lot of these different income type products, which is not what you want. In fact, I just read in the Wall Street Journal yesterday that 16% of the world's government bonds are yielding negative real returns. And so certainly if you're looking at income as a large part of your retirement, or as a large part of your portfolio, then these numbers don't make you happy. In fact, they can be quite devastating if you're looking for that income, for retirement. So a couple other things that we need to understand for income in the income world, and that is the fixed income risk to reward, because we just talked about the reward. The reward they're the yields that you're getting, right, from those different products. And it could be corporate bonds, it could be junk bonds, it could be any fixed income type product. But it's important to understand the risk. And in large part, there's inflation risk, but also there's interest rate risk, which I'm going to highlight now. And the relationship is inverse. And I'm not going to get into the complexities of bonds and that, just understand the basics. If interest rates fall, bond prices go up, right? So if interest rates fall, your bonds will be making you more money. Okay? And in 2008, that's what we saw. We saw interest rates plummet. We saw bond prices going up. Great time to be a bond buyer, right? It was during that time frame. Well, flip that. And if bond prices go up as interest rates fall, well, then inversely, bond prices lose money as interest rates go up. And I'm going to state that again. Bond prices and fixed income prices, we'll say, they lose money, they lose value as interest rates rise. Now think about where we currently are in the market. We have 0% interest rates, essentially. So there's only one place or one direction that interest rates can go. I guess there's two. Hopefully they don't go down even more and yield even more negative returns in some places. But hopefully they, over time, they're going to go higher. Now, when is that going to happen? Nobody knows. A lot of people have been forecasting this for a long time, and a lot of people are saying this year, 2015 in June, July timeframe, then we'll see interest rates go up. We don't know when, really. All we know is that there's great risk as that happens to your fixed income products. So think about that. You're getting very little reward, and there's great risk right now because there's only one direction interest rates can go. And that type of risk-reward scenario isn't ideal in a lot of individuals' portfolios. Now, if you're going to hold your bond till maturity, fine, go for it, right? Have fun. That's fine. And that may be what some people need to do. But for the most part, interest rates rising is not a good thing. So the question is this. If in the fixed income world, which is primarily where people find income, there's great risk and there's little reward, then what other tools, what other products can we use to find income, right? Where else can we go? And that's where options come in. And that's why at IGGA Global, we love using options. And there's three primary reasons why these options are used. The first reason is protection. And we do have protection strategies that we implement and believe in protection. It's also used for income, which we'll talk about. The third reason is speculation. And we're not speculators here at our firm. We use options for protection and for income. And obviously for the next few minutes, I'm going to be addressing income specifically. So important to know that within any portfolio, we have what we call this alternative slice of the pie. And then that alternative slice of the pie is where you will find, these option strategies that we're going to talk about right now. Okay? And so you may still have a little bit of fixed income, but that alternative piece is where we're going to focus to find that income. And that may be larger, smaller, depending upon an individual. This is not a recommended portfolio for anybody. This is just purely for illustrative purposes. So a few things to know. And the strategy actually that we will be talking about for the next few minutes is called a short put option. A lot of people call it a naked put. Okay, it's a short put option. A few things to understand, and I'll dissect these bullet points a little bit more. But short means that you're selling an option contract. Simply means you're selling an option contract. All right? The second thing is when you sell a put, it means you're obligated to buy the stock at whatever strike you sell. Okay? So you're obligated to buy the stock, and we'll talk about strike prices here in a second. Now, you're taking upon yourself an obligation. And anytime you take upon yourself an obligation in the option market, you're going to be paid for it, right? So you receive a premium, which is that income component, for selling that option to somebody else. That's how you're paid, by taking that obligation. And I'm going to share with you an example. And this example is for illustrative purposes only. I'm going to go over to what's called the Thinkorswim paper money platform. This is from TD Ameritrade, and I'm not associated with TD Ameritrade in any way, shape, or form, so understand that. I just like this retail platform, all right? Find the retail platform that works for you if you want, right? This is just for illustrative purposes. And I have typed in here a ticker symbol. And again, for an example only, I'm looking at Valiant Pharmaceuticals. Okay, and I'm going to look on the chart of Valiant Pharmaceuticals because people relate to the chart quite a bit. Valiant Pharmaceuticals has been doing very well. It's been going higher and higher and higher. Let's say, for argument purposes, that it's a very well-ran company. That management is great. that we like the stock, we like everything about the stock, but we don't want to buy it at $169. Okay? We just don't want to own it. It's trading too high. We don't want to buy at the all-time high or a 52-week high, but we still potentially want to own it. And so what we can do is we can sell a put. And let me explain this. I'm going to go back to this trade tab, and don't worry about every fancy little gadget that you see on the software. I'll point to what you need to know. And I'm going to open up, this is the April expiration cycle. So essentially, this option is good through the third Friday in April. So I click on April and I open up those options. And on the right-hand side, I will see these are my puts. So let's look at a few things here. We're not comfortable buying the stock at 170, so where would we be comfortable buying it? And that's the question that you need to ask yourself and that we ask ourselves as portfolio managers all the time. What price would we be comfortable owning Valiant? Well, again, for just example purposes, let's say that we're comfortable owning it at 165. All it needs to do is fall essentially $4 off its current price, and we'd be comfortable owning it. Or even let's use the 160 instead. That makes a little more sense. Let's use the 160. We're comfortable owning the stock at 160. It's currently trading at 169. So what I'm going to do is I'm going to, you can see this bid price, which is the price you sell. I'm just going to left click that option. Okay, let me just make a quick adjustment here. We're not going to sell 1. We're just going to sell, or 10. We're going to sell 1. So I'm selling 1 put on Valiant Pharmaceutical. Again, just an example. The April expiration, the 160 strike. Now remember back to that PowerPoint we just looked at. We're obligated to buy Valiant if it falls to 160 or lower on expiration day. Okay, so if Valiant goes up, then we're not obligated. If it goes sideways, we're not obligated. Even if it goes down a little bit, heck, we're not obligated. We're only obligated to buy the stock if it falls to 160 and below. So that's our obligation. Now, anytime, again, you take upon yourself that obligation, you've got to be paid for it. And so in this case, we're going to be paid, and I'm just going to move this to 450 just to keep the numbers easy. Let's say we're paid $4.50 for every contract that we sell. Each contract, by the way, if you're unfamiliar with options, represents 100 shares. So we're obligated to buy 100 shares. Okay? So we receive $4.50 or $450 for selling that put. That's the income. And the income comes if Valiant goes up, sideways, or even down a little bit. As long as it doesn't fall too far, then we receive that $450. And I'm going to push on a little button just to illustrate the point a little bit more. I click on this, and it tells us our max profit, our max loss, which I'll explain, our break-even price. Okay? And then I'm going to talk about your potential return on investment as well. But if I'm looking at this, my max profit is $450. That's not including commissions. There are commissions involved, all right? May take that down just a little bit, but let's just look at $450. The risk, the max loss is $15,000, and that's if Valiant were to fall to zero. If Valiant falls to zero, then we're in trouble. That's your max loss. And there is risk there. It's a very, 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 very low probability, but that is the risk. Understand the risk. The credit that we're receiving, and this does include commissions, is $439.26. So factor in that commissions, from TD Ameritrade. So let's look at these numbers a little bit. And I'm going to do some math. The buying power effect is how much cash we're tying up. Now, this is a margin account. This is not a retirement account. We're tying up $2,500 essentially of capital to make $440. So our return on investment is right around 5.6%. in that 50-day time frame, 57-day time frame. So from an income perspective, and in any trade, you're not going to realize max profit most of the time. You may bring in a little bit less than 5.6, but just looking at the raw math, that's a 5.6% return on investment in 57 days. Now consider or compare that to the 5-year CD yielding 1.5%. And you should be thinking in your mind that, yes, there are income opportunities here as long as you're comfortable with the risk, right? So within Iron Gate Global Advisors, we have an income portion of the portfolio that we allocate to our clients that are looking for income and are comfortable with options and the risk associated with options. And we pick, not Valiant, that's just an example, but we pick those stocks that we're comfortable owning and that we want to own. And we sell puts on them to create that income. And then if we're obligated to buy the stock, we're fine with it because we like the stock anyway, right? And so that's the approach to it. That's a very high level explanation of the selling puts approach. So let's go back to the PowerPoint here, and that's the income approach. Here's what we discussed in our short 15, 16, 17 minutes together. We talked about the current state of income in today's market, which is brutal. We talked about how options should be used in a portfolio, which is for protection and income purposes. For this video, really income. And then we taught you the IGGA income strategy from a high level. If you have questions, also understand too, before we get to the questions, that these are the other strategies that we implement for our clients. Selling puts, certainly we just talked about collars for concentrated stock positions. We do long puts for protection. We do vertical spreads for a combination of income and reducing portfolio volatility. We can do a lot of things with options, and it's all on a one-on-one, what our clients need and what they're after and comfortable with, for that matter. So as far as how we can help you, if there's any questions, feel free to reach out to me. You've got my email right in front of you, brett@igga.com. Our phone number there you can see. You can connect with me on Twitter, on LinkedIn. And again, any questions, let me know. Thanks for listening.
This is a purely public broadcast and is not intended to be personalized financial advice for any individual's specific situation. Each individual's financial situation is unique, and the topics discussed on this broadcast should not be relied upon and/or considered as personalized advice. Specific financial securities discussed are not intended to address any listener's particular financial situation and should not be considered recommendations. This is for educational purposes only. For more information, please contact Iron Gate Global Advisors at info@igga.com or by calling 888-591-0334.